I don't know first what your reaction was when you saw that WTI contract going negative. Is this going to be something that we need to get used to? Will it be recurring in coming months?
Well, I think it's important to distinguish between the fundamental story here, which argues, yes, we'll see it likely reoccurring, versus the positioning story that made this one exceptionally extreme. So let's quickly talk about the fundamental story. This was a well-flagged event. We saw negative prices in the mid-continent of the U.S. before this. It was expected for inland crudes. Brent is a waterborne crude. We don't think it could happen at a waterborne crude because you can get ships in and out. A landlocked crude like WTI that trades 500 miles from the water versus Brent that trades 500 meters from the water are very susceptible to the large surpluses moving through the system that are likely to breach storage and distribution capacity. And once it breaches that capacity, it's like traffic on a freeway. You just can't move anymore. And as a result, you can get an environment where producers are willing to pay someone to take their oil away. And that's what a negative price means. We have seen it before. It was expected. Now let's talk about the positioning story. Because we had seen this happen in '09, where as you go into expiration, the front end of the curve collapses. It was driven by ETFs and other long retail products that are long going in the end. They have to get out of their long position, which means they have to find somebody to be able to take the other side and take them out of that position. Now, some of the other funds like the U.S. Oil Fund had done it earlier. By the way, now that everybody's aware of this, the U.S. Oil Fund has now extended its options to be able to roll and to further back contracts to avoid this happening. Now, the point here is they waited right up to the day before expiration in a market that had no physical strength. In fact, there was no way you're going to be able to deliver that oil. And also, you had a market that didn't have much liquidity. So, it's not a surprise that they were having to get out of this position at minus $55. And I think the key point here is that's unlikely to repeat itself.
But, Jeff, where are we in terms of actual storage that's exhausted? Is this a global phenomenon, or is there storage left somewhere?
Well, the local phenomena is playing out in, think about like a rolling base. It happens one place, it happens another place. The global story, we think, is going to occur sometime in the next 3 to 4 weeks. Because remember, this is like a tsunami of a surplus moving through the global distribution system. And you can think about the production cuts. It's like building a dike up, a mile outside of the water, but the wave is on the other side of the dike. There's not much you can do to stop this. We think it occurs sometime in the next 3 to 4 weeks. And when you hit that point, supply must equal demand. Let me repeat that. Supply must equal demand, because if you can't put another barrel of oil of surplus in the system, you have to have supply down in line with demand.
Right.
And so if demand begins to recover a little bit, you can get a deficit. Mm-hmm.
Jeff, a delicate question, and I know your general counsel's not going to like it. I want you to speak right now to global hydrocarbon, to the CFOs, the CEOs, the operating line officers of all these companies that are probably going to go bankrupt. What's their best practice right now? How do they prepare for the Midland, Texas of the 1980s that we all know is coming, particularly within the Permian Basin?
Yep. The advice I have been giving for the last 6 weeks is find a ironclad offtake agreement with a counterparty you can trust that has a very strong way to dispose of that oil and is also very strong from a credit perspective. Other than that, you're very much exposed to the current environment. In fact, what we're likely to see, many of the different smaller players do not have firm transportation, do not have ironclad offtake agreements. This doesn't just apply to the Permian; it applies on a global basis. And so as we go through the next 3 to 4 weeks, demand can be down as much as 18 million barrels per day in the middle of May. It is, by the way, the peak demand losses are probably behind us. So let's say demand's down 18 million barrels per day in May. Supply is going to have to be down the same, at least for a temporary basis until the market starts to rebalance itself. But so I think the key point here, it's not a financial one, it's a physical, logistical one, and those left out are going to have a very difficult time over the coming months.
Mm-hmm.